Okay, let's test our skills with some of the ratios and some of the financial calculations that we've looked at during weeks 2 and 3. All right, to start, someone pick your favorite company that you might want to know something about. Make sure it's a publicly traded company. Disney. You a Mickey Mouse fan?
I'm only Mouse though.
One of the great management companies.
Mm-hmm.
There's a book that they produced on customer service. It's worth reading. And there's a lady in my church whose dream just come true. She graduated 2 years ago from high school, and she's been in local acts and plays and things. She just went in for her second tryout and just got picked up as she'll actually be a character down in Orlando.
Oh, that's cool.
Oh, my daughter did a semester down there in the college program.
That's
It was
cool.
awesome.
I do not like that job. Do you know which character she's going to be in?
No, because that was the first thing that I asked.
Yeah.
Yeah.
They're gonna be. Well, and then they have to say that they're friends with that character. They can't say they're going to be that character. They're friends with friends.
Okay, so here what I'm bringing up, courtesy of Yahoo Finance, is we have Disney's balance sheet. Okay.
And when we turn the light off, it'll be a little
Yeah.
less glare.
Well, that'll mess up your.
Okay, now what I'm going to ask for 1 bonus point.
I'm grateful.
You're grateful. Who can tell me what the current ratio is for Disney?
Which column is most current data? On the far left or far right?
What column is the most current data?
Okay,
So let's apply October 3rd, 2015, period ending.
Gotcha.
All right, and I'm just going to kind of slowly go through some of the numbers. If you see something that you want to pause on,
Let's make it back up.
Stop.
Oh, you can see it on there. Which column are we looking at? First, second, or third?
Okay, first column.
First column.
I think I've got a number.
Whoa.
I think
What's
I've got
this?
it.
Okay, hang on.
All right. Kyle has a number. Let's see what.
Whoa. I just messed up.
Wait a second.
Big numbers.
Oh, yeah.
So that's exactly what I did. That's not right. My numbers didn't count.
No,
You didn't put enough zeros.
Current ratio.
2.019.
You know, and this camera's not going to pick up on that view.
You just make this.
So let's see if I can do it.
Disaster.
No, but if I don't have it on there, so.
Current ratio is equal to what?
Total assets over total liabilities.
I hear total assets over total liabilities.
Current,
I 2 to 1.
total current liabilities.
Total what?
Total current assets.
Total current assets
Divided by total current liabilities.
divided by total current liabilities. For Disney,
182. 30.
let's get our data back up here.
Is that 88 million? Or did they get it? See, I got 16. 16.
What are Disney's total current assets?
88.
182,000.
Mhm.
Oh, there's total current assets up there.
Yeah.
Not total assets, total current assets.
2.132.
isn't it?
2.132.
It says one current assets, 16,758.
Oh, yeah.
Now, let's pay attention.
Oh, I was looking ahead.
What are these numbers being reported to us in? What does that number represent?
Millions.
Thousands?
Let's see if we have a footnote down here. All numbers are reported in thousands. So 16,758,000 would be stated as
16 billion.
$16,758,000,000. What are the total current liabilities?
16,013,034.
16,334,000,000. What is my current ratio? Kyle,
1.025.
you were the one who had it solved.
I thought.
He had it solved.
Incorrectly.
You thought.
Had it solved incorrectly.
Yeah, I missed
I
the,
will admit.
I looked at the total assets to total current assets.
That's what I
I
did.
had total current liabilities, but I didn't have total current.
Yeah.
So what's the number that I get?
1.0259581.
1 point what?
1.02.
It's a
1
zero.
point what?
0.
1.0.
Sorry.
O is the letter of the alphabet.
O is a letter of the alphabet. The pet peeve of any financial professional. Remember, O's and zeros, and we don't make money. Okay, so we see we have a current ratio of 1.02. What does that number represent? What does that tell us?
The total
So we
assets.
need our final obligations. So that's how much they actually are worth right now?
No.
I mean, not worth, but the capital they have on hand.
No.
They have on hand, no?
Well, when you say what they have on hand, this is what they would have at a short term. Remember, what they could readily get to in a short term.
Right.
What they could be expected to get to within 1 year or less.
Mhm.
What they are expecting to use within 1 year or less. When you ask what are they worth, they being publicly traded, you've got to take their share price multiplied by how many shares are outstanding. That's going to give you what's called a market capitalization, which would in turn give you the value of the total company. So if I have a current asset or a current ratio of 1.02, what's that tell me?
Well, it's not negative, so they're profitable.
Barely profitable.
Okay, let's not focus on the profit term.
They barely have enough to cover their liabilities. I shouldn't say barely. They're slightly above the amount needed to cover their current liabilities.
So how long could they cover their current? It's not a measure of profitability. It's a measure of,
Not long.
If they didn't take any more money in, wouldn't it be 1 year? Because isn't this a measure of one calendar year?
I would say, look at my textbook.
Okay.
Let's not speculate.
Days cash control.
Can we read it?
Sure.
The basic indicator of financial liquidity for an organization's ability to meet its financial obligations. Higher values indicate a better debt and capacity. The current ratio does not take into account the relative liquidity of the different current asset accounts.
Correct. So what that says is it's a measure of liquidity. It's a measure of how they can meet short-term obligations. It says it does not take into account any measure in the liquidity of those current assets. Because remember, you're going to list everything from cash, accounts receivables, any short-term notes. So if we get a measure of 1.02, again, what's that number telling me? Specifically, how long can I pay these obligations?
A little more than one time.
A little more than one time, define that time period.
One time that they come due? One
When?
month?
When are they coming
When
due?
they have to be paid
A
out?
fiscal year?
Yeah.
During a fiscal year?
Drop the word physical
This year.
Just a year.
and just say you have a year. Current assets are 1.02 over. Now, look at that. Who says they can pay for it for just a little over a year? I could be leading you purposely down.
Well, you gotta figure though, it's
Year
not
and
all
1
going out
hour.
at once, is the thing.
It's not all going out at once.
Right. So, in theory, as long as that ratio stays where it is, they could continue to operate that way throughout the year in the positive. Meet their obligations.
Yeah, but that's saying if they don't take anything else in, right?
If we stop.
Well, you're saying right now on hand, how long can we continue to meet our obligations? Now, if you just walk in there and say we can meet our obligations for 1.02
Years.
1.02 years. Okay. Question 2.
So is that we're at 1.02 years?
Or converted to days.
You don't sound very confident.
I'm right there with them.
Okay, no one got this one. No one got this 1 point. We'll now move it up to 2. We'll build on it. We'll now move it up to 2. If anybody can correctly tell me how long they can meet those obligations and say it with confidence to where you're convincing the class.
Can I read something out loud?
It will answer that question.
An indicator of how long an organization can meet its obligation if cash receipts were discontinued. The days of cash on hand, short-term sources needed from all hospital reporting and audited financial statements. In this example, was 30.05, but the days of cash on hand, well, no, that's not going where I wanted to.
Average time it has to be for current liabilities. I think it's one billing cycle.
I think he wants
Which would be one billing cycle, which would be
365 days?
yeah, one billing cycle out of the year. So like every 12 months, so one month. One billing cycle would be 30 to 45 days, right? Depending upon how often you have to pay your invoices.
What was the initial question? We changed the number.
Right.
Two,
33 more days.
is that what it was?
Excuse
What
me.
was the initial question again? We changed what to?
Yeah, 1.02, so what's that gonna tell me? And the answer is out there. I wish I could hum the Perry Mason song right now. I was doing Jeopardy a while ago. If we could get the,
Divided by 360.
Well, it's been 6 months. We should
Yeah,
expense
it's
divided by-
365 days, or it could be 12 months, or it could be 1 quarter. I mean, they're all the same thing.
Some assets are like not liability.
okay, should we face any liquidity problems?
Barely know.
Barely no. I would say Disney would not have any current concerns. If I was evaluating Disney, I would not have any concerns of liquidity that they cannot meet their current obligations. What that tells you is you're right. All of your current assets are sufficiently able to cover all of your current liabilities. How do we define current? 1 year or less. Okay, so short-term assets should be able right now to cover all long-term liabilities for a little over 1 year. So I would not be. Question 2. You are the manager of an assisted living facility. You have an opportunity to borrow $150,000 for 1 year at 7.5% interest.
I got it.
150,000.
11,250.
Now, if you just flipped over to the answer, that's not what I wanted you to do.
But I got it, right?
Did he say 7.5%? He meant 8.3%. No, changed.
Change the number.
Now you got
Well, I can calculate it that way if I need to.
Okay, so what do we know?
Interest equals percent times amount.
So what were we given? We were able to borrow $150,000. And what was interest?
7.5.
7.5%. So what amount of interest would I pay?
1,200.
What's the term of the note?
Term of the note would be,
1 year.
61. Oh,
1 year.
thought you meant how much would be due at the end of that year total. It'd be that 150 plus the 11,000.
Okay. So how much interest would they pay?
11,250.
Taking 150 multiplied by 7.5% gives me
11,250.
11,250. Now, what if that compounded for 3 years? The fact that you jumped ahead on me, I'm going to put this next question.
I get 33,750. 33,750.
So the first year's interest was 11,250.
Oh, no, that's not right. Never mind, that's not right. I add
It's,
that
I got
on.
it.
You got it.
I got it. It's 36,344 and 52 cents.
How do you get 36,344?
Yes, I smacked you. You
Well, I want to ask, how did you get it?
What I did was is that I took the principal times the interest 1.075.
1 point what?
1.075 to the third power. You said by 3 years, correct?
By 3 years.
Yeah. To the third power.
So taking that into consideration of compounding. So your next year, you would have had 150,000 plus 11,250. So if I take 150,000 and 11,250, $161,250. What's the interest rate?
7.5.
And what's that?
Well,
This is year two.
year two, sorry.
And it's 20,000,
20,000?
you wouldn't told what you're gonna be.
Yes. If that rolled over,
Okay.
what would be the interest?
$21,735.
$21,735.
That's because 161,250 times 7.5% gives you, okay.
I'm relying on you all right now.
No.
I'm relying on you.
I took the 150,000 times and multiplied it by the 7.5% interest rate to the second power.
Now, right now, let's take 161,250 multiplied by 7.5%.
You get 12,093.75.
Yeah.
12,000.
093.75.
0.95. So in year two, my interest is $12,093.75. So my principal after year one was assuming we rolled over that first year's interest, 161,250. And now we have 12,000 and 93.
Even with this part of it.
75.
That's
It's 100, it's 170, 173,000, the total, of those two, 173,343.
170 what?
3,343.75. If we multiply that times 0.075 or 7.5%, we get 13,000.78. It's even, 13,000 even,
And
0.78.
78 cents.
Yeah.
Now so our total interest then would be the sum of these 3 years. What can we sum? 11,250.
Oh, that's just 13,000, not 13,008. Yeah.
$36,344.53.
$36,334.
I'm sorry, 44.
44. 50.
50, yeah.
Was that the answer that you gave?
Yes. Bear with me, hang tight.
You know, if you wanted to
Yeah.
add that interest payment back onto your original, you would see total money paid back would be $186,344.50.
36, yep, that's what I got initially, by using that third power.
The more it's compounded, the more you pay.
The more it's compounded, the more you pay. Now, keep in mind, what did we assume there was our term?
A year.
A year. So when you say, when it compounds, you pay more, 2 factors you must consider. One, obviously, the interest rate. Secondly, the compounding factor. How often are you compounding that? We assumed here we were compounding once a year. Don't be thrown off if you see a problem. If you're dealing with months, you're looking at monthly compounding, you're going to see a more dramatic effect. Those numbers are going to be stacked and multiplied on a more frequent basis. Okay, last question. Do not flip the page over and look at the answer.
So,
Okay,
Sorry.
you now, as manager of the assisted living facility, have an opportunity to invest $10,944 for 5 years to retire a short, well, we'll say to retire a long-term debt. $10,944. Assume the clinic can invest 7% compounded annually. How much of the debt do you need to retire? So you're going to borrow, what I say, $10,944?
I've got the answer.
$10,944. We're going to assume that you can invest at 7% compounded annually. How much is the debt you need to retire?
I have $4,405.52.
What kind of problem do I have here?
Bad word problem.
But I thought you said you were gonna invest it.
I have an opportunity to do that.
Okay, but then if you're investing it, then you're borrowing. How are you borrowing?
Why are you, yeah.
Why would
Why are
you be
you
investing money you don't have?
You can borrow to invest. Yes,
Yeah, you
absolutely.
can.
I'm borrowing money.
Oh, yeah.
Okay,
I'm borrowing money, but I have an opportunity to invest.
invest at 7%
Correct.
annually.
Is there no?
What kind of problem is this? This is an example of the future value. When we last met, I quickly said, if you have a good financial calculator, even a basic financial calculator, that will be able to solve for you. Okay, let's assume now we do not have that financial calculator. What's the formula?
So future value equals
The
present value times 1 plus the interest rate raised to the nth power, which is how long it's going to be.
The future value is equal to the present value multiplied by 1 plus the interest rate raised to the nth value. What do we call this nth value?
This annually would be 365, or would be 1, right?
85.
It would be 5.
Oh, 5.
This is your compounding factor.
Gotcha. Okay.
It's going to compound. What was our time frame? We're going to receive
5
it for
years.
1 year, but we invested a $10,944 for 5 years.
Okay.
So I got the answer.
Well, let's plug this in and let's check. What's your answer?
My answer is $15,349.52.
Robert says $15,349 and what? 52 cents. Let's test. What's my present value? 10,944. Always going to bring that 1 down. What's the interest?
0.07.
Point what?
7%.
0.07.
0.07. And what are we going to raise it to?
To the 5th
power.
To the 5th power. Now, everyone plug that into your calculator and see if we agree with Robert.
You want to do it again? Make sure I agree with Robert.
Yeah.
What's the first thing that I do in solving this? This might take you back to basic algebra.
Parentheses,
Parentheses first.
then your exponents.
There we go.
Please excuse my dear Aunt Sally.
Please excuse my dear Aunt Sally.
Stand by my answer.
One plus 0.07, and then you raise that to the fifth power, right?
Just.
I'll do it with you here.
I got what Robert got.
Okay, so.
Okay. So just make this a 10.
Did you see how I was doing?
Yeah, I got it.
So, like, so the first thing is,
Yes, okay.
1 point, or the 1 plus 0.07, so we know it's 1.07. So what I do is, because on the punch calculator, it's 10,944 times 1.07.
Math illiterate.
1, 2, 3.
Oh, that's a good way to do it.
That's the best way to do it.
Okay,
I
all
like that way.
right,
You know, financial calculator's best way to do it.
that is awesome.
Okay, without the financial calculator though, how would I solve that?
How I did it was, I took that 1 plus the 0.07, which was the interest rate, so I got 1.07, and then I multiplied 1.07 by 1.07 by 1.07 by 1.07 by 1.07 to raise it to the fifth power, and then I multiplied that number by the 10,944.
Okay, if you have a little hat on your calculator, and I'm gonna call it a hat, kind of looks like a TP, you don't have to punch it in 5 times. And then take that factor, multiply by 10,944, and we have 50% of the class in green. Then it's $15,349.52. I bring these 3 problems up to you because, again, these are things that, as you're looking at budgeting, these are good items that you could take a look at. You know, I want you to think about, in this midterm, we're looking at a household budget. Has anybody ever even thought about what your household current ratio is?
I'm scared to.
I know it's bad.
I'm scared to look at it.
Well, I don't expect it to be as strong as Disney, but it might still be interesting to look at. Again, I'm not asking you to put your own numbers in there, so if you want to run the test on yourself, do it. Feel free to nudge the numbers so you don't have to if you don't want to communicate with me. I understand that. I respect your privacy. Future value. I think this is just a good lesson of something that will do you well and serve you well beyond this class and years and years on with any type of debt management or investment opportunity. So, you know, again, what you just told is invested at 10,944, 7% interest for 5 years. After 5 years, I can expect to have $15,349.52. Here would be a good investment. If you're looking at a savings, if you're trying to save money toward a goal, this would be an opportunity where you would apply a similar type formula. Basic interest charged, again, this is looking at an investment opportunity. The second item was looking at it from a debt management. You know, again, when you're looking at your budget, you're going to be looking at some of your expenses, and some of those expenses may be financed over a period of time. Your home, your car, your education. Okay, taking a look at what is the simple interest, what are you going to pay per year? That's pretty simple. Take the number, multiply it by the rate. But now if we're looking at something over a series of time, we got to play that time card in there. And again, any of those instruments, most likely you financed your home for longer than a year, financed your car for longer than a year. So again, taking that extra step that we did just now would allow you to look at what's the total amount going to be paid back for financing that.
Did you also use that for figuring your return on a certificate of deposit?
This one right here?
Yeah.
Sure, sure. The only difference is you're not going to have 7% interest right
It's a
now.
lot less than that.
No, actually, how much?
Yeah.
I can honestly say we are getting referrals from banks right now in my firm. And we had a lady come in the other day and she said, I've got 2 CDs that I've had for 5 years and they're maturing in October. And I plan on giving that money to you. And I said, well, that's good, but you've had them at the bank because there's something wrong with the bank. She said, no, my banker told me he wouldn't even invest with these rates being so low. So
Yeah.
he told me to put it more towards something else because again, what you're going to get. But absolutely, any type of investment, you know, the CD would be a good option because this is going to assume that rate, you know, you're going to assume that rate is fixed.
Mm-hmm.
Feel free to use any of the other ratios that we plugged in there. And I think you'll be able, I think this exercise, and it is intended that it be very opening, you know, eye-opening to you in what it's going to uncover. Again, we'll expand upon this, as I said in the final, we'll expand these formulas and we'll expand these ratios to include more deeper analogies, deeper numbers. We'll dig deeper in it. But right now, I think this will be a good exercise to tell you, to get you started. Your household budget is going to be a lot more simple than what we assume you have to have. Your departments or your work. Beyond the midterm. Let's go ahead and take a look at what we can expect.